According to supply managers in the 9 Mid-America states, how is the economy performing?
Our survey of supply managers, manufacturing supply managers in the 9 Mid-America states, are not good. It's moving sideways. The overall reading, and this is for the month of November, here we are on the first business day of December, was 49.5. That's obviously just a hair below 50, which is growth neutral, and that's down from October's 50.5. So that's certainly not what you'd like to see. And we just have, of course, right here in our neighbor, one of our neighbors, Iowa, John Deere just announced that their sales are down, their profits are down, and this is moving lower. And that's just emblematic of what's going on across the region. Manufacturing is just not doing well, but it's holding up. I'd say sideways to down a bit. Trade numbers, of course, still weak. Import reading was 37.2, and that's up from 34.0. And export reading 42.7, and that's up also from 40.8. But both those are not good. And if you look at exports for the region, still not as good. And we ask some other questions about AI, artificial intelligence. And some of the businesses are, of course, using AI, and that's showing up in our numbers. And 25% indicated they're using AI consistently in their job. And that's 25%. That's a little higher than I would have thought, but nonetheless, we're going to see more and more AI. Now, will that add to productivity? That's the unknown question. I expect it to, but there's going to be a trial period here, and the trial period may go on for a couple of years. But here, let me bring up the chart here, and there you see it. And I've charted the Creighton PMI in blue there, beautiful Creighton blue, and in the red, that's the U.S. PMI, and that comes out later on this morning. As you can tell, we don't have that number yet. And you look at in there in the dark, the black, that's the rural economy. So you're talking about a large portion of this nation has a large portion that's rural, and that's what we're seeing. The rural areas not doing as well as the urban areas, and manufacturing not doing as well as non-manufacturing.
What were the hiring trends?
Hiring was below growth neutral, but up a bit, and not enough to get happy about or be happy about. 47.6, that's up from October's 46.9, and it's the 8th straight month that the reading's been below growth neutral. So U.S. regions and states losing manufacturing employment, but I have to say in this part of the country, losing it a bit at a slower pace than the rest of the nation, but nonetheless losing workers. And we ask about hiring, and 2 of 3 indicate little or no new hiring, 2/3. So that means 1/3 layoffs or just not completing the question that we ask in the survey. Half reported wage growth approximately matched inflation. Now, you're not a happy camper if you're matching inflation, but obviously that's better than the 40% that said they were less than inflation. In other words, wage growth below inflation rates. So those are even less happy.
What inflation trends are you noticing?
Inflation is moving lower, and that's good in a sense. Why is it lower? Well, I think it's lower because the economy is slowing down. That's not good. But the price gauge, now this is a wholesale price gauge, declined from 62.9 in October to 59.8 in November. And inflationary pressures are clearly waning, at least in the manufacturing sector, and that's good. I think we're going to get a rate cut by the Federal Reserve on December the 10th, but we'll talk about that in a little bit later in more detail. It's the lowest inflation reading since December of 2024. So that was before I'll call it tariff tantrums, but nonetheless, I shouldn't editorialize, but I'm not a big fan of tariffs, as you probably you've learned from previous videos that I've done. But even with this downturn, inflation, the wholesale level and at the retail level, that's the CPI, still above the Fed's target. So obviously that's not what you'd like to see. You'd like to see moving toward the target. and it's more flatlining, I would say, even though ours is down, and you're going to see the PPI probably coming down. And maybe that's foreshadowing a cut. Now the cut in the CPI later on, but what does that mean? It means it's moving toward the target of the Fed, but why? Because the economy is slowing down, the global economy is slowing down.
What is the economic outlook?
The outlook is slower growth in the economy. And now, does that mean a recession? Not at this point. There's a recession for certain parts of the economy. That would be the rural areas heavily dependent on agriculture. That would be housing, where we're seeing a recession in certain parts of the country from housing, residential housing that is. And so I expect a rate cut. Keep an eye on what the Federal Reserve does in moving sideways to a bit down in interest rates. This may be the last cut simply because inflation's, despite what I've said earlier, inflation still remains a problem, and the Fed's going to be really leery of moving rates lower. So you get a 0.25% cut in December the 10th, which means that the prime interest rate will go from 7 to 6 3/4. So that's good. The CPI, keep an eye on that CPI. Again, it's still stuck at too high a percent. The last numbers we got were 0.2% month over month, but also remember, of course, the shutdown of the government. So the statistics, the government statistics were not very good to begin with. Now they're even worse because of the shutdown and what we're seeing there related. And I expect long-term interest rates to move a bit lower. Now that's good news on mortgage rates, but not great news. We're seeing mortgage rates about 6.4% to 6.5%. You'd like to see them even lower. Keep an eye on the bond market. That's always where the action is. That's where the grown-ups sit in the bond market. And at the children's table, that's the stock market. And the stock market's just, it's always good news. That's how investors treat it. Everything's good news. 119,000 jobs. That's the last reading from the Federal Bureau of Labor Statistics. Everybody, oh, great number. 119,000 is not a great number. That's an okay number, a bit lower than you'd like to see if the economy weren't on the verge of a recession. We're not there though. And the yield on the 10-year Treasury, that's what you need to keep an eye on, moving between 3.9 and 4.1 to 4.15 is stuck in that zone, and that's an okay zone to be stuck in because investors globally are trying to, like economists, trying to figure out what the heck's going on here. We've got 2 or 3 economies out there. Some are doing very good, some are not so good, and some are bad. And those not so good is the ones we survey here at Creighton University. That would be manufacturing and bank CEOs in rural areas of 10 states on agriculture. Keep an eye on the ISM reading, which comes out later on this morning. I expect it to be below growth neutral. Price of a barrel of oil is coming down. Now, why is it coming down? Because the global economy is slowing down. So keep an eye on that. Watch out for natural gas prices. Those are going up because of the data centers. Let me just say this. The Atlanta Fed says GDP growth they're expecting for third quarter be 4.1%. That's very good. The problem is it's investment. In other words, data centers. And as you probably know better than I, you can't eat a data center. In other words, the investment there, that's where we're seeing growth, and consumption is just not growing as much. And keep an eye on the jobs report, of course, coming out this month. And the price of gold, it's trying to decide, investors are trying to decide, is it inflation or is it a slowdown? So everybody's trying to decide, including, of course, the president. So that's it. Ernie Goss here at Creighton University in beautiful downtown Omaha, Nebraska, signing off with a reading, again, not so good, but could have been worse. The negatives are getting less negative, if I can say that. So until we meet again, the first business day of January, wow, that's coming up quickly. May your economic cup runneth over, and thank you.